Are you thinking about getting into the real estate market? If so, that is fantastic. I don't want you to be one of the over 7,000 people that default on their mortgages in the first 3 months or more because of lack of knowledge. To understand the question, how much can you afford? You need to look at several factors and understand the important factors lenders use when given mortgages. Stick to the very end of this video where I will share how to determine your debt to income ratio and how much down payment you can afford, which will help you secure a mortgage with a good rate and prevent you from defaulting. I'm Elizabeth Anderson from Almond Oak Real Estate team, where my sister and I specialize in empowering women and minorities to buy and sell real estate to build wealth. If that is something that appeals to you, make sure that you hit the subscribe button and don't forget the bell beside it so that you can be notified each time we post a new video. All right, let's get started. Our first thing we're going to be talking about is debt to income ratio. This is one of the most important factors when it comes to securing a mortgage. What is debt to income ratio, also known as DTI, and why is this so important? Basically, it determines how much you can afford to pay, and it takes into account all your debts, your monthly mortgage payments or your mortgage payment, and your income to provide the percentage of how much your income is going towards paying your debt. The lower the DTI, the better. Lenders tend to want a DTI of 44% or less. Let's take a look at an example. Sally has a gross monthly income of $4,000. She has a credit card payment of $120. A car loan payment of $240, student loan payment of $120, and a mortgage payment of $2,000. In total, Sally's payments is $2,480 of monthly debt payments. To find out Sally's debt to income ratio, we will take a look at her monthly debt payments and divide it by her monthly income. Her debt to income ratio here is 62%, which is too high. The lower the debt, the better. Okay, let's look at what mortgage lenders want. Lenders will look at your debt to income ratio as well as your front end debt to income ratio. Your front end debt to income ratio, also known as your mortgage to debt ratio or your gross debt service, includes income and your monthly payments or your mortgage payment. And the lenders are usually looking at no more than 39%. And this is regardless if you have debt or not. Lenders want to make sure there's wiggle room in case there's an unexpected emergency. Let's look back at Sally. Remember, her income was $4,000 a month and her mortgage payment was $2,000. Her front end debt would be 50%, which is, once again, too high. The lower the debt, the better. So if you are looking to buy a house in the near future, start paying off as much as your debt as soon as possible. The easiest way to do this is through the snowball effect. If you would like for us to make a video to explain a little bit more about the snowball effect, let us know in the comments below. I promise we will look into down payments. I'm not going to be going into full details about down payments because we've already done a video for that. If you haven't watched it and you want more information, or you haven't watched it, pause this video and go back to that video and watch it. The link will be in the description below. To avoid mortgage insurance, you need to put down at least 20%. Mortgage insurance can be another 2.8% on your mortgage. But sometimes we can't put down the full 20%, and that's okay. There may be reasons why you might not be able to put down 20%. You can still buy a home with less than 20% down, but putting down 20% will lower the payment, which will mean smaller payments. Remember, the goal is not only to be able to afford your home today, but most importantly, that you'll be able to afford it in the long haul. Knowing what is required to get an approval is really important. And now that you know more about debt ratio, you will want to check out our next video where we will be sharing a few more important factors that lenders look at before lending you money for a mortgage. If you are thinking about buying a house in the near future and have any questions on the process, how to get started, or want to position yourself to buy in the future, we'd be more than happy to help you. Reach out to us. Our information will be in the description box. I will see you in the next video. And remember, building generational wealth is for everyone.